So what I'm going to do is, I've got the not very enviable task as an economist to try to give you a sort of very broad message about the global economy. What I'm not going to do is I'm not going to give you forecast about where the global economy is going. One, because it doesn't really matter because we always get it wrong. But the second thing is that what I find interesting and more relevant, and this is the message I'd like to get to, in the forecast that many of our colleagues or ourselves are giving, is that we've got a very sobering view for this year. We say essentially 2020 will be the same as 2019, not very inspiring, but don't worry, it's going to get better. 2021 will be better. And the question, why do we do that? I think the reason we do that is because implicit in our forecast is the idea that macroeconomic policies can close the demand gap, can improve the situation, can raise inflation, can get where we want. And I think that is exactly the point we've got to challenge and the point we've got to keep in mind and what I would like to focus my message about. What I'm going to deliver right now is the eulogy of monetary policy, which is unfortunate for me because it's a field I've worked quite a bit in. But I think we've got to get used to the idea that for the next decade, we are not going to be able to rely on central banks the way we have been to in the past. In the past, whenever something bad happened in the global economy or in markets, we tended to think, let's not worry, that's okay, because the central banks will fix it. And in most cases, they did. But now I think that's a much less convincing message. And I think it's got it's got a number of implications. One is that we've got to be more sensitive to the fact that macro shocks of any kind may take a life of their own and make it more difficult to stabilize. But the other one, which is maybe a more positive one, which is that the consequence of that, I'll try to come to that, is that rates won't move. So we've got to also get used to the idea that we're living in an era of zero rates on probably for a long time. So to try to make this demonstration, the way I explain it is how does monetary policy works? The way monetary policy works when you have a shock or you try to boost growth is that typically central banks are trying to bring down rates across the economy, not just short-term policy rates, but all the rates across the economy. And the expectation is if rates go down and the cost of finance goes down, then we're going to consume more and to invest more. But that runs into three obstacles at the moment. The first one is circumstantial, but is the fact that we're living in an environment of what I call qualitatively higher uncertainty. Not higher risk, but higher uncertainty. Think of Brexit, which has not been sorted out. The dispersion of plausible operating environments for many of us is so wide that, frankly, it's not a small change to our cost of finance that is going to make a big difference to our willingness to deploy capital. We're going to need a little bit more clarity as to exactly what is going to be the environment in which we operate. And that is compounded by the fact that deferring a decision to invest is actually very low, because in many industries, what happens is that one of the main risks that I have in deferring investment is that tomorrow I might have missed my window and my cost of finance has gone up. But the central banks, on this they can do, are promising us that this will not happen. That through forward guidance, the insurance approach will come back, financing conditions will remain very easy for a long time. So the cost of deferring a decision until I've got more clarity is very low. So that alone reduces traction of monetary policy. But more importantly, I've got two other issues whereby monetary policy stops being effective when we reach zero rates, which is where we are at the moment. The first one is how it works through banks. So the problem, that's specifically the trial of negative rates. Remember that many central banks have got rates near zero or will get there. Some of them in continental Europe, Sweden, Switzerland, Denmark, and Japan have gone through zero, so have gone negative. The problem when you go negative is that while the risk-adjusted return on bank assets goes below zero, their cost of funding falls less, because part of their cost of funding is retail deposits, and the rate on retail deposits remains sticky at zero. And the result is that you're putting inevitably part of bank balance sheet in negative carry. You're creating a drain on bank profitability, therefore on bank equity, therefore on credit supply. And therefore, it's not quite so obvious that cutting rates is actually increasing the supply of financing in the economy. The other way, which is almost more perverse, whereby negative rates stop working, is through savings on consumption. There again, we traditionally live under the idea that if I cut rates, people are just going to spend more. They're going to borrow more, they're going to spend more, they're going to save less, because what's the point of saving when you don't get any return? So the assumption we're making here is that people are saving only because they want to buy something bigger and better next year or the year after. But most people don't. In Europe, for instance, 2/3 of savings are people who save for long-term consumption. They want to fund their retirement. They want to fund the education of their children. They want to fund a sort of long-term objective. So if you're saving towards a long-term consumption objective, what happens in rates go down is you don't decide suddenly to spend today your pension income. What you do is because the rate of accumulation of your financial assets goes down, you might in fact be incentivized to save more to compensate, to make sure that you keep your consumption objective in the future. And if that is true, then what happens is, as I say, it disables monetary policy, because when I cut rates, instead of people saving more, less and consuming more, they might save more and consume less. And this is pretty much what is happening now. So can I prove it? Because the people will tell me, well, hold on a second. Your story doesn't make any kind of sense. Because if it were true, when rates went from 3 to 2, 2 to 1, I should have seen consumption going down, and I saw consumption going up. So why is it different? And I said it's different because we are below zero. When you go below zero, it becomes different. And the reason it's different is because we don't think in real terms. We think in nominal terms. So when rates are positive, think about the taxman thinks nominal, accountant thinks nominal. We all think nominal. So we're sensitive to nominal rates. When nominal rates are positive, we think we're okay. We might underappreciate the fact that real rates are in fact already negative. But when nominal rates become negative, we think something's wrong, and we change our behavior. So can I prove it? I think so. So first I'll give you a folkloric example of that, which has to do with continental Europe. For the past 30 years or so in Germany, real rates have been negative on and off. And nobody ever batted an eyelid. But nominal rates become negative in the summer of 2014, and since then there's an uprising. Everywhere in the press, you see Savers Association up in arms. The Bild Zeitung was describing Mario Draghi, my former boss, as Can Dragula, sucking the blood of widows and orphans. And so you've got all this. The reason I'm mentioning this is because what we're talking about is perception. And in economics, perceptions matter because economics is just the study of human behavior. Can I prove it a bit more seriously? Yes, I think so. So if you look at the savings behavior, which is what I'm interested in, and you look at surveys, for instance, where people ask, do you think it's a good time to save? Do you intend to save? Are you going to save more or less? And in the past, we had a regular relationship. When rates went down, people thought it was a bad time to save. They would consume more, and indeed they said, I will save less, and they save less, and they consume more, and vice versa. Since rates have become negative, this relationship has blown apart. People on the whole have said it's a bad time to save and a worse time to save, and yet they said, I will save more, and they have saved more and consume less. And this slowdown in consumption explains a substantial part of the slowdown of economic growth the past 2 or 3 years in continental Europe. In Japan, we had the same thing. When rates became negative, you had a drop in consumer confidence and consumption, not a rise. So the opposite of what central banks expect. So if I'm right, what it means is that something really happens when we go negative. And that means that the central banks that have gone negative might think it was not such a great idea after all. And indeed, the Riksbank, for instance, the Central Bank of Sweden, has gone back to zero with what really looks like an attempt to try to escape negative rates while they still could. But what it means is that for the future, I think we've got to accept that zero is truly a limit. And that, paradoxically, so not only that it disables monetary policy as a way to stabilize the economy when we have low level of rates, but it creates what I call a gravitational pull towards zero. It gets us closer to zero. Why? Because if you agree with even 50% of what I've said, and if you are a central bank that is still above zero, that has space, and the concern you have, you say, is that if inflation becomes too low, growth becomes too weak, and I'm not going to have the tools to stabilize it. So therefore, if I'm going to make a mistake, and I'm always going to make a mistake, which mistake had I rather make? I'd much rather make the mistake of overstimulating the economy rather than understimulating it. Because if I overstimulate the economy, well, maybe I make a mistake, and then I've got inflation, the economy overheats a bit, and that's okay, because I'll always be able to pick it up. I can always tighten afterwards. But if I make the mistake of over-tightening or easing too early, so essentially breaking a bit too hard, then the economy falls in the trap I was mentioning. And then I can't pick it up because I no longer have the tools, and I'm on my own because the others won't help me. I'll come back to that in a second. So that, I think, creates a bias that you will find in all central banks in the world, which is I'd rather over-ease than over-tighten. I'd rather keep policy rates low for too long than normalize them too early. And if in doubt, jar the cat. On this, I think, has been describing quite well the behavior of many central banks over the past years, but it should get even more like this, which means if you're a central bank like the Fed, which has policy rates, say, if in doubt, cut. And so the get to zero rather faster. So it's also this pull to zero. If you're already there, which is the case of pretty much all central banks in Europe or in Japan, then you can't get out. Because the question is, if monetary policy doesn't deliver very much, how do you do it? You can't do it on your own. You've got to rely on other policies to do it for you. So other policies will be fiscal policy, regulatory policy, and so on, the tax policy. I mean, we can come to that in a second if you want. But these policies, you don't control them, and they're very slow to move. So if you want, now I think we're pretty much in a bit of a gap here, where I think everybody comes to realize that monetary policy is not much able to stabilize or to lift the economy, but nobody is really picking the pieces. And nobody's picking up the pieces because the way we structured policy making was precisely so that these policies do not work together. Well, over the past, so that's the other consensus of the past 30 years, which I think is blowing apart, is for the past 30 years also, the consensus was that we could separate economic policy into different institutions, that it has one tool to deliver one target. So we've made central banks independent, with the idea that an independent central bank can always stabilize the economy and deliver price stability. A treasury, all on its own, can deliver an efficient allocation of resources in the economy. A bank supervisor or financial regulator, on their own, can deliver financial stability. That is not true. And as we get to the zero bound, we're realizing for rates, we realize ever more that it doesn't work this way. That in fact we need coordination of policies. For instance, if we want now in those countries that have a shortfall of demand, continental Europe, Japan, to raise demand, we need a much more forceful and consistent combination of monetary policy, fiscal policy, regulatory policy, all working together. But the system has not been structured this way. The UK is the world champion of having created over the past 20 years independent executive agencies of government that all operate on their own separately from each other. Quite often we've embedded in law or in bylaws this separation. And now we've got to come over that. And that is going to be quite difficult, which is why I think that in the near term, what we are faced with is that, say, this gap here, monetary policy is losing its potency. We are not yet in the mindset, or we don't have yet the policy architecture to be able to get policies to work together. And therefore, we're left with an economy that is okay. I mean, our forecast is not that bad. I said it wasn't inspiring, but the global economy is not in a particularly bad state, but it remains very fragile. And in the meantime, and this is possibly the good news for many of your clients, is that rates are stuck in many parts very close to zero or at zero, in some cases even below zero, and it's going to be very, very difficult for them to emerge from that until we've made this sort of mental shift towards coordination of policy. So because I always talk too much, I don't know if I've exceeded my time or not, but really I just wanted to leave you today with a fairly simple message, which was this one. We've got to live with the idea that central banks are no longer a safety net for the global economy, and we've got to pay much more attention if we want to know whether the economy is going to grow or do better. We've got to pay more attention to other types of policies. So I was mentioning fiscal policy, which is pretty obvious. But there's another one which I'm particularly interested in, which is regulatory policy. So I'll give you just one example of that, which has to do with continental Europe, which happens to be the area I'm supposed to know more about. I think the one thing that we are suffering from is the opening gap that we've seen between the cost of debt and the cost of equity. So that is a global phenomenon. The cost of debt under central bank impulse has fallen very substantially. The cost of equity has fallen, but not by quite as much. So the equity market looks expensive, but in relative terms, arguably, it's not. Now, why does it matter? Because if the cost of debt is too low relative to the cost of equity, you don't have much incentive to deploy capital in the real economy. Your incentive is to issue debt to buy back shares. And so that makes a lot of sense near term, but it doesn't bring capital into the economy. So how do you do to move capital into equity form into the economy? So you go to the root of the problem. So some people will say the root of the problem is central banks, because central banks have bought so much of moved to asset purchasers, they've bought so much debt instrument that they have taken down the cost of finance. But the objective of central banks was to bring the cost of finance everywhere, not just the cost of debt, the cost of equity, the cost of everything. So why has it not happened? So my view is that the reason it has not happened is largely regulation. In Europe, we've got a regulation that makes, and not just in Europe, by the way, a substantial distinction between debt instruments and equity instruments, which actually makes it very difficult to reallocate institutional money, think insurance money, for instance, from debt to equity. And therefore, as central banks have bought debt instruments and pushed down the cost of debt, many people have been locked, if you want, in that, so it created a squeeze, and this opened a gap with the cost of equity. So some people say, well, central banks just have to buy stocks, and that will equalize it. And I don't think so, because what you want is you want the flow of savings to move from debt to equity, so this can be rolled out. And the implication is that you need regulation to be adjusted to play along with that. I could take you other example. I could take you other example about fiscal policy or others. But I think really now what we are going to become much more is less central bank watchers and more watchers of regulation, of fiscal policy, of other policies that combined with the very low rates that central banks are guaranteeing us for many, many years to come, can reflate the economy. And if it doesn't, we'll have the problem that suits some of your clients but doesn't suit very much the rest of us, which is that super low rates bring up asset prices, create, if you want, the inequality of wealth of stocks that people are talking about, which is fine, but doesn't actually do very much to reflate the economy. I don't know if I spoke too long. I always speak too long. I was asked to speak no more than 15 minutes. And the trouble with economists is they always speak way too much. And I was asked to leave a few minutes if there was pushback, disagreement, or any question, please.
So what's the regulatory change that you advise the governments to make to shift the motives for people to go from debt to equity?
Oh, so one of the, so I'll give you just a big example as well. So my preferred one would be to change in Europe Solvency II, so insurance regulation, to actually facilitate the relocation of savings into equity form. And so essentially, you've got to accept that de-risking pension funds or quasi, so insurance product, is not viable. So another one is I would move away from self-insurance. I'll give you one example. And I'm sorry that it sounds very technical, but just try to explain what I mean. LCR on NFSR, so the liquidity ratio on net stable funding ratio for banks, do not take account, so we do not consider as liquidity assets that banks hold that they can mobilize as collateral at the central bank to get liquidity, but that are not by themselves very liquid assets. So central banks accept collateral that is not very highly liquid, and therefore you could say, well, this collateral is liquidity. You should take into account the ratios. And the regulation doesn't do that. So why? The reason why the regulation doesn't do that is because fundamentally the regulation has been built under it's got a good reason, but under the notion that everybody has to self-insure. You should not rely on mutual insurance mechanism. You should rely on just your own 2 feet. If we all self-insure, then we're all going to save too much. You immobilize resources that otherwise could be put out to better use. And that, I think, is a global phenomenon that's been particularly pronounced in Europe, where we're replicating slightly what Asia did after 97. So I'll be very brief, but this is a useful point. After 97, Asian countries, on the whole, decided that they should never ever face a crisis like they had faced, which was the crisis of balance of payment, so they needed to self-insure. And self-insuring took 2 forms. One, it is virtuous. You try to reduce your vulnerabilities. For instance, you try to reduce the amount of foreign currency in your external debt or these sort of things. The other one sounded virtuous, but was not. It was, let's build up huge buffer of FX reserves. Because if I have huge buffer of FX reserves, I've got my own liquidity, so I'm safe. Simply to build up these huge buffers of FX reserves, what you need is you need to have them. To have them, you count surpluses to fund them. So they put in place policies that led Asia to have massive counter-account surpluses. A counter-account surplus is an excess of savings over investment because it comes from a trade surplus, an excess of supply over demand. The excess of savings over demand brings down yields, real yields everywhere, real return on money, and the excess of supply over demand brings down prices everywhere. So Asia has been a contributor to the deflationary environment that we've had ever since. In Europe, after the great financial crisis and the euro crisis, we did exactly the same. We decided that we had to self-insure. Everybody had to stand on their own 2 feet, and therefore we've tightened everything. We've tightened bank regulation, as I was mentioning. Governments have tightened their fiscal policy. So it sounded great, let's reduce debt, we're going to be stronger if we've got lower levels of debt. Well, not quite, because the result is we've contracted fiscal policy in periods where the economy was weak, and we've worsened the downturn. At the level of countries as a whole, we've all moved into counter-account surpluses, which are, as I said, an excess of supply over demand, an excess of savings over investment. And this has contributed to pushing yields down and pushing prices down. And that is what the central banks have worked against. So my point to you is that it's not just one single piece of regulation, but it's a mindset of regulation. I think we've got to, the pendulum has got to swing back. We've got to move slightly away from the focus on self-insurance, which has been really dominating the past 10 years, and try to see how we can recreate mutual insurance mechanism within borders and across borders that allow effectively to free resources which otherwise are tied up unproductively and are hampering the growth potential. And of course, Brexit doesn't help because every breakdown of international relations is not going to help to rely more on this mutual insurance mechanism.
Any more questions from the room? Okay, we have one on Slido. We've got 2 on Slido. Is there a safety net if central banks can no longer provide it?
No, not until such time as we recreate the coordination of policy. So this is where fiscal policy can come back in. But you need to do it coordinated, which means so who's the choreographer? If you want, in the past, the great choreographers were people like Bernanke, Mario Draghi, people who have been able to go, talk to governments, talk to regulators, convince them of what had to be done. I think these people are gone, and it's not obvious that they replace because the people who replace them just simply don't have the tool. So the question, one of our people I talk to often, they say, who's the new Keynes? Who's the person who has both the intellectual capital to try to understand and formulate this shift on funding that we're going through, and the ability to influence, convince our elected politicians that we've got to shift the architecture of economic policy to that. And the answer is, I really don't know. At the moment, I don't see one, which I think we're very fragile.
Do you think Keynes would have been good at Twitter?
And Keynes' style, I don't know if you've ever tried to read Keynes in extent, so his style is actually quite difficult. So I don't know, and the sentences are very, very, very long. So I don't know on Twitter how it would have worked. But we need a new one. That's what we need, really.
Can you see a higher risk of inflation in the Eurozone after the ECB has been pumping so many euros into the economy? No, because the argument is making the reason why we don't have much inflation is because we have a shortfall of demand. This was my Asia 97 comparison. We all self-insure, so essentially Germany, the Netherlands, huge counter-account surpluses, essentially a shortfall of domestic demand. Yes, they may saturate capacity. Yes, they might operate near to full employment, but there's still a big shortfall of demand. Until we close that, I think the risk of high inflation is zero. I know you're an expert on Europe, but will the US economy still drive the global economy, is another question.
Well, at the moment, I think, less and less, because the ability of the US economy to drive the global economy, to some extent, in my view, was reliant on an open global trade order. And now the global trade order is still, I know you said that the globalization is still on. Globalization is being seriously challenged, and I think for good reasons. The globalization is being challenged because the political perception of globalization, I'm not saying the economic reality, I'm saying the political perception of globalization is that it works if it's fair. And by fair, it's got to be balanced. David Ricardo, who is the thinker behind globalization, even though that was a couple of centuries ago, did not say England will sell wool to Portugal, Portugal will sell, the world is better off. He said England will sell wool to Portugal, Portugal will sell wine to England, and that is why everybody is better off. So that's a historical example. What I mean is that the idea is that trade has to be balanced. And I think that a global trade order where you had significant trade imbalances was always going to be challenged. Remember back, this was 30 years ago, when driving a Japanese car in the US made you a traitor, because at the time it was Japan who was the adversary. So I think inevitably, when you have very large imbalances, countries that have very large surpluses on some very large deficits, you are going to run into a political challenge. That is understandable. And I think this is where we are. So the US could drive, and I think will still drive in the near term the global economy. But going forward, the question is whether countries that have been operating, that the reason the world was so reliant on the US is because those countries were so reliant on US demand because they did not create their own demand. So China, Germany in particular. And I think those countries have to realize now that either they've got to create their own demand to absorb their own domestic output because it will be more difficult politically to sell to the rest of the world, or they've got to want to maintain an open trade order, which I very much hope they succeed. In that case, they've got to create their own demand to absorb imports, including from the US, so that they can continue to earn the right to export to the rest of the world. So I think we'll probably see a rebalancing.
Any more questions from the room? Okay, the final question from the audience. Do you see a chance of the debt loads of large economies, such as the US, falling to a more healthy level in the next 10 years?
No, sadly no. The question is, what do you call a healthy level? Because what matters is not so much the stock of debt, but it's the affordability of debt. If I'm right to say that essentially rates are going to be very close to zero for a very long period, we have very low inflation, but we still have a bit of inflation, and we still have a bit of growth. The implication is that the cost of funding of government, in particular, is way below the nominal cost of growth of the economy, which means that when they borrow, there's no fiscal cost, because who's going to pay for that? Not future taxpayers. It's the people who lend them the money that actually guarantee rates of return which are way below the rate of growth of the economy, and therefore they are effectively paying for that privilege. So even though the stock of debt may not fall, it doesn't mean that governments cannot, not everywhere, but cannot spend money on that issue. It's not a good idea. It is actually probably a really good idea for them to spend money on the ecological transition or public investment, and also simply, by the way, cutting taxes to raise demand, because in fact, their taxpayers will never have to pay for that.
Brilliant. Thank you very much. That was great.